Hi there, welcome to this video series. I'm going to outline how elite traders and investors use fundamental analysis of stocks, but also considerations of the economy to generate profits. Now, the methods that I use are derived from what Warren Buffett does, so that's a pretty good blueprint to start with. But before we actually get to fundamental analysis, the important first step is to have a look at the environment to see if it's conducive for stocks for the next 6 months, 12 months, or preferably a couple of years. So the reason that I believe that markets will remain positive for the foreseeable future is that tops occur in markets when stocks are overvalued relative to other investments and everyone's bullish, and that's definitely not the case where we're at now. So let's just have a quick look at what the current conditions are. We've got the continuation of extremely low interest rates. They've moved up a little bit in the last few months, but they're still extremely low. We've got easy credit. The US Federal Reserve has basically decided that they're going to keep the money presses running very hard at the moment. So they're absolutely committed to continue to print money. And the other thing for me, the other key thing is that sentiment is not bullish. There's still a lot of people who were bruised in 2008, who haven't come back into the stock market, who are nervous about Europe and nervous about Japan, about all sorts of things. So by no means is this a situation where the market is very bullish. So when all the people aren't in and interest rates are low and credit is really easy, you just do not get significant tops in the market when those sort of conditions exist. So I just cannot see that there is a basis for a significant correction at all. Now, the other way of looking at this, of course, is why the Fed can't stop printing money. And there's some very important fundamental reasons why that's the case. The first one is that interest rates are going to rise, and that'll kill the housing recovery, and it'll also get in the way of getting the unemployment situation down as well. So that's one key reason that the Fed, I don't believe, can move. The second one is that if interest rates rise, then government debt costs will get out of control. So the Fed's not going to let that happen either. And if they stop printing, then interest rates are going to rise, and that could lead to a really nasty cycle. And of course, the other thing that's happening in America is that there are spending cuts, which are now a matter of law, and they are actually hampering the economic recovery. So the Fed has really got to keep printing money to offset those spending cuts. So there's some really important fundamental reasons why I don't believe the Fed's going to stop printing money, and that's going to be very positive for stocks. So the minimum conclusion that we can make, I believe, at this point in time, is that yes, we'll get volatility over the next couple of years, but a significant correction, I don't believe that's going to happen based on the facts and also based on the self-interest of all the major players. So that means that high quality stocks that are bought cheaply can then perform on their merits. Doesn't necessarily mean that they can go up, and there'll be poor quality stocks that won't go up. So this will not be a period where all stocks rise. But it does mean that the way is then clear for high quality stocks which are bought well to perform on their merits. And that's all that we can ask, really. So there's definitely a window of opportunity that I believe is not going to be repeated for a long, long period of time. I just don't think it gets any better than the conditions that we've currently got. So let's turn now to fundamental analysis process. The key first step is to identify the very best stocks on the market that we can find. And I've been doing that progressively over the last 2 years or so. And it's a very dynamic process, but it's one where I feel that I've got a real handle on the very best stocks that our market has to offer. And it needs to be pointed out that only a small minority of stocks are really high-level, consistent, fundamental performers. Most of them aren't. There's less than 100 stocks on the Australian market that I would consider to be in that elite category. And these stocks are not the big stocks. The big stocks are in their mature phase. They're not going to provide high growth returns over the next 2, 3, 4 years. They're in the smaller to mid-cap stocks. And it's also worth noting that There's nothing wrong with buying smaller companies. All great companies used to be small at one stage. So what I do is I go through and I assess the financial performance of those stocks over a period of at least 3 to 5 years minimum. So that means we're looking at up to 10 reporting periods. So that gives you a really good picture of the financial performance and also the reliability and stability of that performance. And I then assess the outlook for the following 2 years, because it's one thing to understand where the company's been, but it's also important to understand the environment that the company will be in for the next couple of years to get a sense of whether that performance can be sustained. Now, the second key step, once you've done that, once you've identified the highest quality stocks in the country, is then to value them using a realistic formula. Now, there's lots of very complicated mathematical formulas that you can use. They're all unnecessary in my view, to be precise, because the market can just do something completely different in terms of how it prices a share anyway. So this is a situation of just getting close enough to the truth, making sure that you've got high quality stocks and you've got a valuation which is realistic. And as I said at the start, the methods that I use are pretty much Warren Buffett's methods. He's proven them over 4 to 5 decades, and you know, they're certainly good enough to achieve what it is that we want to achieve. And the methodology is really based around future earnings of stocks and the dividend streams that those stocks are producing as well. Now, the detail of how to analyse them properly in the subsequent video series, I'm going to be covering what is absolutely vital to understand and what parameters are absolutely vital. But just as importantly, what's irrelevant. There's an enormous amount of information out there on the net if you've been searching, and you'll know that the volume is just horrendous, and it's very difficult to understand what's important and what's not important. In this video series, I'll zero in on exactly what it is that you need to know, and it's the basic Warren Buffett formula is pretty much it. Look, I love all this stuff. I've been doing it for 30 years, and I put out a lot of free information which you can access at our website. So if you'd like me to send you a weekly update, then just fill out the form on the site. This weekly update outlines the key things that are impacting our market, plus a strategy overview. I'll also send you videos teaching my key principles of creating consistent profit and longer-term wealth. I really want you to gain a big edge on the market and on everybody else. So click on the button on this video or in the description below and join in with our community of traders and investors. Cheers for now.